The world's first insurance policy was signed more than 600 years ago in the then Republic of Genoa. This financial milestone remains relevant to today's individual investors. An individual investor is anyone who deploys cash today with the goal of receiving more cash tomorrow. Whereas all investments aim for a positive return, they are also subject not only to risk, but also uncertainty. What is the difference between risk and uncertainty? In the classic thoughts of Frank Knight, risk involves outcomes with known probability distributions, while uncertainty comes with unknown probability distributions. Why is this important to you? Simple. While risk can be covered by insurance, uncertainty is usually not. To what extent is insurance useful to individual investors? We will give some thoughts to this question as we look back at the first insurance policy ever written in Genoa 1343. According to historian Pietro Masai, the prehistory of insurance stretched from ancient times until the 1300s, and was characterized by various primitive forms of protection against uncertainty. Historians point to the first record of a mutual association for sharing risks in ancient Babylonia, in a practice known as bottomry. Bottomry was given legal force in the Code of Hammurabi. Along with Babylon, bottomry was also applied by the Phoenicians, ancient Egyptians, Greeks, and Romans. Note that bottomry dealt with events for which a probability of occurrence was difficult to identify and quantify. Because traditional bottomry bundled a loan with insurance, it cannot be considered a standalone insurance contract. But this would change in Genoa in the 1300s. How did Genoa become wealthy? Historian Robert Lopez explains that the city-state of Genoa went into maritime trade much later than Venice, but caught up by the 1200s. Genoa relentlessly expanded its foreign trade routes. In 1261, Genoa replaced Venice in the control of trade in the Black Sea. In the 1300s, Genoan merchants were first in the commercial dividends of the Portuguese reconquest of the Iberian South. Genoans were also first in trade routes via Gibraltar to London and Bruges, and first in opening Persia and South Russia to trade. In short, commerce was the backbone of the Genoan economy, and the source of its wealth. In 1293, the returns of taxes derived from Genoan sea trade generated income of roughly 10 times the receipts of the entire French royal treasury. Italian city-states by then were 4 of the 5 largest cities in Europe. Genoans were also innovators. Nautical maps are first mentioned in Genoa. Genoan ship designs were innovative, and it seemed that the Genoese alone navigated in the heart of winter, thus almost doubling the utilization of their ships. Genoan maritime innovation also extended to finance. Historian Humbert Nelli reports that, on February 13, 1343, an individual named Amigueto Pinello signed a contract in which he declares the receipt of 680 gold florins from an individual named Tommaso Grillo, in exchange for promising to repay in case of loss of a cargo shipped on the galley named Santa Catalina. This is the first historical evidence of the legal and structural break with the age-old marine loans. This first contract was worded ambiguously, to bypass clerical laws against usury. The marine loans, which had been adequate in ancient and early medieval times, could no longer fill the needs of the sedentary merchants of Genoa. Pietro Masai notes that marine insurance then became practically universal among the maritime nations of Europe. Marine was the mother not only of many other insurance branches but also of insurance law, including the concept of indemnity. In Barcelona, back in 1435, the first statutes for marine insurance appeared, in times when both Italy and Spain were in the forefront of marine insurance. The emergence of insurance law also enabled the expansion of insurance far beyond the marine domain. The application of insurance beyond the marine domain soon followed. In London, 1536, the first life insurance was issued to William Gibbons, who received an insurance policy that allowed his beneficiaries to obtain £400 in the event of his death, in exchange of a premium of £32. In present day, any risk that can be quantified can potentially be insured, and so the list of available insurance types is long and growing. The sources we learned from to produce this video were written by historians. All work is cited in this page, and we encourage our curious viewers to read for themselves. What do these tell us altogether? First, whereas the idea behind insurance tracks back to the ancient world, the world's first insurance policy evolved from a business need in Genoa, in 1343. The goal was to transfer of specific, quantifiable risk to others for a payment or premium. Second, the concept of an insurance policy is powerful and flexible enough to go way beyond marine insurance, and so it did. This brings us back to our original question. To what extent is insurance useful to today's individual investors? Yes, insurance is a useful tool for today's individual investors, but not across all asset classes. If you invest in real estate, insurance makes perfect sense in most cases. But other asset classes such as stocks are less relevant for insurance. Remember that you may insure only against risk which is quantifiable, but usually not against uncertainty. How about bonds? Could individual investors manage risk in their bond holdings by buying insurance? A case in point is the greatest trade ever, in which hedge fund manager John Paulson made billions by betting against bonds backed by subprime mortgages in 2008. How did he do it? He bought credit default swaps, or CDSs. Whereas a CDS is technically not an insurance policy, its gist is quite similar. However, be careful. Whereas the financial press often describes CDS as insurance, it is not. It is a derivative. As Michael Lewis detailed in The Big Short, CDS price behavior oftentimes is not what one would expect. CDS markets are not liquid. Spreads are usually wide. You must monitor counterparty risk at all times. And when you want out, you will be at the mercy of market makers who will gladly rip your face off. CDS is not for beginners.
Thank you for watching. If you'd like to learn more financial history from verified sources, subscribe to our channel and join our community of individual investors who strive to learn from the misfortunes of others to avoid similar fates.